Capital repayment, interest only, what are they? What's the difference? That's exactly what I'm going to be going through for you. So first of all, what are they? And if you stay long enough, I'm going to give you a top secret that the banks definitely don't want you to know that's going to save you thousands. So interest only is kind of what it says on the tin, right? As you are taking a debt out, or in this case, a mortgage for your investment property, and you're paying that monthly balance every single month, none of it is actually going on the property, like the loan that you're borrowing. Instead, you are paying down an interest payment. For example, if you have borrowed £100,000 from the bank to buy your property and the interest rate is 6% a year, then that's going to be £6,000 a year or £500 a month. So each month you're going to be chipping away £500 for that 100,000 loan. But at the end of the term or the period of the mortgage, whether that's 20, 25 or 30 years, you will still owe £100,000. Doesn't sound great, but it actually is. On the other side, you've got repayment mortgages, which is what it says on the tin. You are paying mostly interest at the start, but you're chipping away at the capital. So if we borrowed that 100,000 at the 6%, we're going to be paying above the £500 mark. But each month, everything above that £500 is going to be chipping away at the debt. So that at the end of the 2025, 30-year period, you are debt-free on the property. So, which is best? But before that, let me just explain the difference between good debt and bad debt. So bad debt is anything that is a liability. So technically, buying your own home is a liability, although some would say that's a pretty good. What about a new car? What about a new watch that's not considered an investment piece? What about spending loads of money on holidays, for example? Now, I'm not saying you shouldn't do these things, but if you're going to use a credit card, a debit card, etc. to get them, that is considered bad debt. You are spending money that you don't have that isn't generating anything for yourself. On the other side, you've got something called good debt. So a good debt might be an investment property. I'll just leave it at investment, actually. So an investment property, it could be investing in gold, it could be investing in stocks, and all of these things, because they have good investment value, especially property, the banks will give you money to help you grow your portfolio. Now, why would a bank do that? Because they make their money by giving other people money, just like you, just like me, to enhance it. And then the idea is you put somebody in that property, let's call them Steve, that's going to pay you the money that's then going to go back into the property and the loan over a period of time. So let's look at a graph to demonstrate this and the power of it moving forward. And really, this is about the value of property over time. Now, there's no guarantee that a property will go up every single month, every single year, but in general, over the long term, property goes up in value. Now, I know there's going to be one or two people to watch this go, not in my area, blah, 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 blah. Yes, there are areas where that's just not going to be true. If you own a property in the middle of a mining town in the northeast, for example, then it's unlikely to be going up in value significantly. But if you buy in a good area where there's logistics, there's investment, there's development, you're going to be really unlucky if you hold that for 10 years and it goes down in value. In fact, in pretty much every area in the UK, there is not a 10-year period where the property values have gone down ever, okay, over a 10-year period. So over time, typically, you'll see something like this. The value of the property going up, and then it's got this exponential curve upwards. But specifically, what I want you to think about is the debt portion of this, and then I'm going to talk to you about a very little known secret that's going to save you thousands of pounds, and that's going to guide my opinion on interest only versus repayment. So if we look over this time period, over this axis, let's say it's 25 years. Well, scenario one is this interest only dotted line here. And what that means is at the end of the period, what you are relying on is an increased value of the property than you started at the beginning. That's the only way it really works out well, because over time the value's gone up, and so the debt level just really isn't a big deal. But when you compare that to a capital repayment, what happens at the end of that same 25-year period is it's paid off. Now I'm going to talk through inflation in a moment, but first, the big secret you need to know about. Before jumping into that, I just want to say a big thank you to Lendlord, today's video sponsor. If you've not been on Lendlord before, you can incorporate a lot of this analysis automatically into your property analysis before submitting your offers, and you can link in all of the finance opportunities so you don't need to pay for a financial broker for your properties. It's completely free to get access to all of that, by the way. The way they make money is if you use one of their products, which you're only going to use if it saves you money. So if you're not on Lendlord, you can click the link in the description. It's completely free, and a massive thank you to Lendlord again for sponsoring today's video. So here's the big secret. When you're going through this period, we're going to pretend that all of this adds up to 25 years. What you think is happening is, I'm paying down the capital over time, right? But actually, if this is your first, let's say 5 years, 10 years, 15, 20, and 25, give or take, right? It's terrible, 25 years. What happens is, let's say you pay this amount here, £500. Now you think you're paying £500, what? I don't know, at the start, maybe you're thinking, 350 of that's on interest, 150 remortgage, right? But no. What happens is, this little amount here is the repayment part of it, okay? So out of £500, what you'll probably end up finding is that about 25 pounds of that is repayment, and then the rest in this section here is going to be debt. And then what happens through time is, it is very slowly, it will go down like that. And it's actually more, if you can see this curve, like that. So almost all of the debt, and this black represents that debt, almost all of the debt on a repayment mortgage is actually on the back end of a mortgage, right? And you might think, that's not a really big deal. Well, isn't it? Because if you think about what you do in a 5-year period, if you're anything like me, you just want to capture some of the money that's gone in there. So if the property is increased by £50,000, you want to get as much of that in your pocket, right? So you're going to end up refinancing at this point here onto a new 25-year model, thinking, wow, I must have paid off a load of money, right? And people think, yeah, that's what you do because you get to pull out more and more money. No, actually, what people are doing is they're pulling out money from the growth of the value of the property. The actual amount that they've paid off is tiny. Absolutely tiny, because you paid off this section here, you're refinancing, going on a new 25-year product, at which point you're just paying that interest again. So, Jamie, what's the big secret? Well, that's the secret that you need to understand, but more importantly, what can you do about it? Now, important at this point to say, I'm not a financial advisor, this is not financial advice, but it is the way that I would do things if I wanted to pay debt down. What I would do is I would get it on an interest-only mortgage, which, by the way, in the UK, almost all buy-to-let properties are interest-only until you get to commercial. And then you can pay off up to 10% per year with no penalties whatsoever, right? No penalties whatsoever, you can pay it down. So instead, what you could do, and you don't need to, by the way, you might pay off £1,000 or two. You might get a bonus from work and go, do you know what, I'm going to chip it down a little bit. Maybe you go, I'm going to chip down £100 a month. And you might think that's the same, but actually it's not, because you can directly pay off the capital, not have anything going towards the interest payment from it, and get that time frame of the mortgage shortened down. Now, in my opinion, I'm not looking to pay down anything, but knowing that I can pay down up to 10% of my debt every single year with no penalties whatsoever, that's really good and a powerful thing for you to know as an investor. The final thing I want to talk about is the silent killer, or financial killer at least, in property, and that is your friend, inflation. Now, you might think inflation is not my friend. Inflation has screwed me royally over the last year, and that's because we were all bloody idiots and kept money in our bank accounts, right? That is the only time inflation is a killer. My recommendation, if you've got a load of money in your bank account, is to either spend it or invest it. Just 100% do not save it. Now, you might be thinking, well, why would I not do that? Well, let's look at the value of the pound. Now, value of the pound, just so you've got an idea, is how much does your pound buy today? So let's go in pence, just so you know, if we looked at today, so 100 pence, and let's go back to 1975 here, and we go up to 2022, just so you can see this. The value of a pound here, what do we think it was worth just, what are we talking, 48 years ago almost? Well, we're actually just shy of that £7 mark. So the value of a pound, if you had a pound and you went back 48 years, you would be able to buy 7 times the amount. Now, the thing is, often people talk about the value of property going up, which is incredibly important, but actually what inflation does is decreases the value of the debt. So what this would mean is, if you go back, in this case, 47 years, I think it is roughly, and we had £100,000 debt on our property, and we fast forwarded to today, if we got this back then, and inflation is always a bit of a killer. And by the way, this is averaged inflation, not the 10% plus inflation that we've been paying. Can you work out what that would be? It's £14,285. So if you've got £14,285 on your property right now, you'd be thinking, that is insanely low debt. Now, in real terms, by the way, it's still 100,000, but that's what would be the equivalent of. So back then, you'd be buying property with that sort of debt on it or less. And now, if you go back from there, it'd be 7 times less. So it'd be 2,020 quid. And you think, bloody hell, that's nothing, right? And this is because of inflation. It is eroding the value of each pound, which is really, really good for people that have got debt. So it's something like the government's in huge debt, by the way, trillions in debt. And inflation, the way it is now, wipes off the equivalent of £400 billion worth of value to debt that they've got right now. And the reason they do this is because the world's economists truly understand that inflation is how you actually make money for those people that are taking on good debt to increase their portfolio. Hey, this is just my opinion, of course, but I absolutely love debt. Now, you need to be safe. 75% loan to value or better is going to be really good. Don't try and be cocky with it and get 100% mortgages, even though they are available. It's just leveraging too much, especially with a market that will go down a bit and up a bit. You really need to factor that in. And my opinion is, considering inflation and considering how debt actually gets paid down on that curve rating, then for me, I'm going to be focusing on interest only. Now, the great thing is, if you don't know what a great financial product is, you can talk to a really good mortgage broker on this. And as I said, if you don't want to pay out for a mortgage broker and you just want to see what options are available to you, you can go on Lendlord. It's completely free to do. You don't need to use them, but at least it gives you an idea of what you're going to be paying, the pros and cons, the entry fees, etc. And again, if you don't have Lendlord, I'll put a link in the description and it's completely free to sign up. I hope that's been valuable. I hope it's given you some really good insight on this and my opinions. Please, again, just take them as my opinions. Let me know what you think in the comment. Interest only or capital growth, and why. You don't need to agree with me, by the way. That's a great thing about opinions. We can all have one, and I'd love to hear yours. If you did get value from this video, make sure to lightly tap the like button. And of course, if you're new to the channel, you want to find out more about property, investing, mindset, and scaling your property business, make sure to hit the subscribe and the notification bell, and I'll see you in the next video.